Hi, welcome to Search for Ease, the weekly newsletter from INR Bonds. I am Arjun Patsati, and in this week we talk about how you can investors and financial advisors for their clients protect the client portfolios against rising inflation in interest rates. Now, interest rates are rising. It's very clear. We have the 10-year Indian GSEC yield has risen to 6.75%, almost 100 basis points or 1% from lows seen post the COVID. So when when COVID hit a couple of years back and RBI started to cut rates and keep policy very accommodative, then the yield went up, the 10-year yield went down to around 5.77 or 75%. Now it is at 6.75%, almost 1% higher. So interest rates are rising. And even in the US, the US Treasury yield has risen from 1 to 1.85%. It had gone down to as low as around 0.5% post the COVID. And the reason interest rates are rising is because inflation has kicked up uh, very sharply in the last couple of years, largely due to ultra loose monetary policies by the Federal Reserve and all other central banks in the world, and which has fed into tight labor markets and supply shortages, uh, heavy demand, and supply shortages, pushing prices higher and higher. And this doesn't seem to be stopping. And so there is a bit of panic at the central bank level. And the Fed has just come out and said that they're going to start hiking rates starting in March. And when the Fed starts, all other central banks, many central banks have already started to raise rates, like Brazil, Australia did it, and others are also going to do it. And so it's a matter of time before RBI also does it. So clearly, I think we have a very strong case for interest rates rising. And the most vulnerable part of the maturity here is the very extreme short end. So in India, RBI has brought down the repo rate to 4%. And the reverse repo rate, which is the rate at which RBI borrows monies, that is, takes out liquidity from the banks, it is at 3.25%. Now, at these levels, and there's enough of money in the system, well over 6 trillion rupees or rupees 6 lakh crores, then interest rates are very low, and the banks fixed deposit rates for investors have are really pathetic. As also the GSEC yields, which for the 1 to 3 years, which is around 4% to 5% levels, and also you have tax-free bonds that are just offering around 3.5, 3.6 to 4.5, so depending on the maturity, 4.5%. And these are also going to rise. So clearly, investors have, if they want safety, if they want tax benefits, they're just not getting anything at all, because inflation in India is at 6%, which is core inflation, and looking to trend higher. And with interest rates going to rise, then even this is not being offering any protection for investors. So they are at a dilemma, because if they invest in very short-term bonds, they get nothing. And even if rates rise and inflation stays high, they are still earning a 3% negative carry on inflation, which is hurting their investments. And clearly, I think even if you take 5-year Bharat bond ETF, it's not really moved up. 5-year GSEC yield has moved to well over 6% levels. Bharat bond yield is still at around 6% level. That is at 2026. So even the PSU bonds are not offering very great returns, and so are the AAA bonds, which are still in a 6 to 7% range. And when it's 7%, then the maturity is much higher. And then when high maturity means, as in rising interest rates, the bonds tend to lose much more value, and also deny the investors the opportunity cost of investing at higher interest rates when interest rates tend to rise over the next 1 year period. So clearly, how do investors protect their portfolios against inflation, rising interest rates? So one is, we are at INR Bonds. We are very comfortable with bond laddering. And if you download our app, QuickInvest, buy INR bonds on the iOS and Android devices, all you need to do is download the app, see the best bonds to invest in, and then invest in a different maturity. So 1, 2, 3 year bonds is what we recommend. And we also have identified a list of bonds that are giving much better interest rates, which is again higher than inflation, what inflation is in India. So this protects the investor as well as the maturities come up, then if the, for example, if 1 year in 1 year time or 6 months time, if there is a bond maturing, then that maturity can be invested at the longer end, in whereas we expect interest rates to rise. And at the longer end, the yield would have risen, so you could get much better yields than what you're getting now. And also, you're protecting the portfolio against more rise in interest rates. The second is you have floating rate bonds. Again, you have many floating rate funds, and floating rate bonds. You have the government of India auctioning for floating rate bonds almost every week, every fortnight they offer an FRB floating rate bond. But again, there you can invest in those bonds, but yields are very low there. And given that the yields are very low there, you're still not benefiting from uh, you're still earning less than what inflation is, and this is not doing great yeah, uh, investments for your portfolio. But the fact is that when interest rates tend to rise, the yields on the floating rate bonds also rise, and then you benefit from the higher yields. So you have floating rate funds or floating rate bonds. These can offer some protection, but they may not offer the best protection given they have their own intricacies and they have their own issues on floating rate bonds. INR bonds has given a knowledge video on YouTube on floating rate bonds. You can go and check it out. Uh, and also the other way to protect the portfolio is to just remain in cash. When I mean cash, it's either liquid funds or very short-term paper like 1 month treasury bill or 1 month commercial paper or 1 month bond or anything maturing in a month, and keep on reinvesting uh, in these monthly papers till interest rates rise over the next 6 months, and then you can take a call on whether you want to invest in the longer part of the curve or other parts of the yield curve. So if these are some of the ideas that can help advisors speak to their clients to protect their portfolios, or clients if they are well aware of how to invest, they themselves can look at some of these aspects of protecting their fixed income portfolios against rising interest rates, as well as bond laddering also helps them to time equity markets. And our bonds have a very large section on bond laddering on the YouTube. You can again go to subscribe to our YouTube channel. You'll get all these videos. So download QuickInvest for INR bonds for iOS and Android and see the best bonds to ladder or the bonds to invest in uh, that gives you better than inflation protection, returns, as well as maturing in a very short 1 to 2 year or 2 to 3 years time. So you can still get good returns and reinvest at higher yields as interest rates rise. And also do not forget to subscribe to our YouTube channel. Thank you very much for listening in to Search for Yields.